Okay, before we head into the market outlook this week, just a reminder, I have a live Q&A scheduled for July 16th at 6 p.m., which is today. So at 6 p.m. New York time, Toronto time, however you want to think about it, Eastern time. I'll be on YouTube live for questions. Also, tomorrow, let's hop over to the Applied series. Tomorrow will be the first video up in the Portfolio Management and Construction series. I've already done it. It is setting up our screens. That is the first step we're going to go through, and it is just what are we going to look at in each of the particular markets, in forex, in fixed income, in commodities, in equities, in different indexes that we look at. What are the things that we want to keep our eye on during the course of the day? So that'll be up tomorrow. On Friday, we added another one in financials. Understanding Banks Part 2. It is on liquidity. How do we assess a bank's liquidity? And next week will be Understanding Banks Part 3, Market Risk, particularly interest rate risk. How do we assess a bank's exposure to interest rate risk? And what is it doing to hedge itself from interest rate risk so that we can understand what happens if interest rates go up 100, what happens if it goes down 100. That'll be next week. Okay, let's head in. Well, let's have a look at the week that was. And the week that was I think, very good for the bulls. The inflation reports that came out, the immediate response was, well, this is bullish because it will slow the Fed down, or maybe there's only one more rate hike. We're going to look at PPI, and I will describe again the difference between CPI and PPI. And when we look at PPI, we'll ask a question about company revenues. And then at the end of the week, we had the banks reporting earnings, and didn't seem to be any shortage of good news there. Next week we get into it. The next 3 weeks are big weeks for earnings. I think this week coming up will be dominated by earnings. The Fed is the week after. Let's have a look at our rates. Money market rates have opened up a spot for a rate hike. We can see here on the 1 month and the 2 month, it is moving to open up room for a 25 basis point hike, which the odds are still on a 25 basis point hike even after last week. And the market is already making interest rate cuts on the long end of the curve. The market cut interest rates on the 10-year by 23 basis points, on the 7-year by 29, cut rates on the 2-year by 20. So in the capital market, the market is already cutting interest rates. In the money market, the market is already pricing in a rate hike. So what does that mean? Deeper inversion. If the capital markets are pricing in rate cuts and the money market is pricing in rate hikes, you're going to get a deeper inversion. Look at the 3-month to 10-year. 26 basis points. Deeper inversion over last week. So we're at negative 166. The record here is 189 on May 3rd, the record for this cycle. Also, the 2 to the 10, a little bit of a dip here, down 91 inverted by 91. The numbers beside it are for the Canadian market, because Canada, shockingly to me, and not to everyone else it seemed, but to me, raised interest rates 25 basis points. I didn't think they would do it simply because of the level of debt that Canadian households have and how much more sensitive Canadian households are to interest rate hikes because of the nature of their mortgage market. But they went ahead and did it. So that just led to much deeper curve inversion in Canada. Look at the 2 to the 10, 129 basis points. That is very deep. The 3-month to the 10-year, pretty much on par with the U.S., 165 basis points. After the rate hike, most banks followed suit and raised their prime lending rate and raised their mortgage rate. So the nature of our market, our mortgage market, is that there are people every day that have to go back to the bank to renew a mortgage they took out 5 years ago. and it resets at a higher rate, a much higher rate than 5 years ago. So their monthly payments increase quite a bit, unless they have more cash to put down, an equity downstroke to lower the amount of principal to try to keep their payments the same. But putting that equity downstroke on takes spending power out of the economy. Having a higher mortgage rate per month takes spending power out of the economy, and this is happening every day. So there are more and more calls for a much more severe downturn in Canada than you would get in the US. If there is a goods recession meaning that when we look at CPI, we see goods deflation right now, and if that continues, and if the recovery in China just doesn't show up, the commodity complex probably would take a hit, and Canada is big on that. Energy, metals, materials, metals and mining. Canada's rather big on that, so it would hurt Canada more. So we'll talk about the Canadian dollar and the position I have there and why I have that position. But it looks, the money market is looking like it's saying, yeah, 25. Capital market is saying, yeah, but that's going to be the end of it. There's going to be rate cuts, so we're already going to start cutting rates here. And earnings so far are saying, look, this stuff doesn't work. Look how good we're doing. There is no neutral rate. You're not at a neutral rate. When we look at the earnings from the banks, loan volume is up. That means that these high rates are not deterring individuals and companies from going to the bank and getting a loan if they can. The balance sheet runoff continues. It's a slow pace considering how large the money supply is right now. We keep hearing about, it's that the money supply is shrinking. It's the lowest it's been since the Great Depression. That's not true. That is not true. The level is near record levels. I mean, we're just coming off of major record levels. The growth rate in the money supply is negative. So when people say it's, the money supply is shrinking faster than in the Great Depression, from a very high level, we're nowhere near what it was back then. But it is at a slow pace, slow enough that it's not really having much of an impact. So balance sheet runoff can continue, and I don't think it's going to have much of an impact at all. Down 2.4 billion. Balance sheet is now at the SOMA account 7.53 trillion, and the Fed balance sheet ran off by 1.39 billion. So SOMA's off by 2.3. Balance sheet's down only 1.9. So there was a net increase outside of the SOMA of almost a billion. Money market funds are decreased by 20.37 billion, but not decreasing in the way you would think. Retail increased 5.23 billion, a decline in government of 0.241, and an increase in prime of 5.45 billion. Institutions decreased 25.6 billion. Prime funds increased 4.72. Government decreased 29.37. And this is because there's issuance. The Treasury is issuing bills and bonds, which means that institutions don't have to go into money market funds to access the reverse repo. They can just buy the securities themselves. Now, what we should see, if this is going on, and if that is the correct thesis, that money is coming out of government money market funds, because that was the only way to access supply, was through money market funds that could access the reverse repo facility, which is a quasi form of getting government securities, and going directly, then that money should not be going into the reverse repo anymore. We should see a significant decline in the use of the reverse repo, and we will test that on the next screen. All right, let's look directly at the reverse repo. Our first thing, down to 1.74 trillion. It has not been that low for a long period of time. Down another 81 billion because, as I've said on the previous screen, there is now issuance. The Treasury general account up another 9.3 billion. If you look at the daily statements, there's a lot more going on than just a increase of 9.3 billion. It has deposits and it has withdrawals, and it has a name of the department Money coming in, money going out, money coming in, money going out. And at the very end, it has another small little table, and this is all the issuance, which shows how much was issued for the day. A lot going on under the surface. This small amount here sort of belies the mess that's going on under the surface. FOMC, 10 days, and we got to get through a jungle of earnings before we get there. July 28th. 2 days, Canadian CPI and PPI. That is a big risk event for the Canadian dollar. It did weaken significantly on Friday with a growing belief that the Canadian Central Bank is done. They can't possibly go anymore given the fragility of the Canadian household, the sensitivity of the Canadian household to rate hikes. This is the test. Are they done? If it shows progress on CPI, and PPI, then there is a belief that it will be done. The Canadian, I think, will continue to lose strength, but if it comes in hot, all of the strength it lost on Friday will probably gain itself back. There are different calls on the Canadian. Some are calling for as high as 128.5 and others as low as 137. So we'll see. This CPI report, I think, will do a lot to determine which of those 2 points the Canadian dollar will head to. Strengthen the 128.5 against the US or weaken the 137. Not a lot of Fed speak this week. Only bar on Tuesday. Quiet period because of the meeting next week. Probabilities haven't changed much. Have a look at this in the week over week. Now, it did change during the week, but we ended the week right where we started. 93% probability on a 25. For the end of the year, all of the weights moved down. 6% from 4.6 down to 1.8. The 5.75 dropped from almost 31% to under 20%. 5.5, one rate hike, 53.3 down to 49, close enough to call that unchanged. No rate hikes went from 11% up to almost 30%, 28.2. So there is still a camp thinking that we'll end the year at 5.25 where we are, which could mean one rate hike and one rate cut. Whoever's thinking about the rate cut, I think that's wrong. The effective federal funds rate 5.08, so we can calculate our lags. If we go back 3 months, look at the effective federal funds rate, look at it now, that means there's 25 basis points that still need to be felt if we believe that there's a 3-month lag from the time it hikes to the time it finds its way into the economy. Academic research sort of points to 12 to 24 months, somewhere in this range. And it's not as if they're saying the rate hike won't be felt. They're saying the full effect of the rate hike won't be felt, which means that there are partial effects of the rate hike that are felt, but it's unclear as to, well, what is that glide path? What is the partial effect that is felt? So that when they hike rates, is it 7% that's felt immediately with, after 3 months, 12% is felt, after 6 months, 27%. That would be more interesting. But it's just the full effect of the rate hike is not felt until that point in time. And the glide path, I don't know if it's linear or curvilinear or what. But if we just sort of take somewhere between 9 and 12, which I calculated a while back, just back of envelope calculations based on how much or what proportion of debt would be floating rate versus fixed rate, we're somewhere between 200 and 350 basis points. And there are some institutions and some businesses where the full effect of the rate hikes have been completely felt because they have nothing but floating rate debt and no derivatives to hedge out any of that risk. And there are some companies that have hedged out all of their risk and are actually not feeling these rate hikes, and some even that have overhedged knowing this that are actually benefiting from the rate hikes because of their hedges. So, maybe that cancels off some of the ones that didn't do anything. But we do know for sure that 100% of the rate hikes are not being felt. We do know that for sure because of the existence of long-term fixed rate debt that's locked in at low rates, of a whole bunch of debt that corporations had issued before rate hikes and overlaid with fixed for floating swaps so that they have a fixed rate in place for the next 5 years. If they did that in 2019, 2020, 2021, then you're looking at 2024 and onwards before they really start to be felt. So we do know that 100% of the rate hikes have not been felt, that each quarter more and more of the economy starts feeling all of these rate hikes. So even though the central bank may stop raising rates, that does not mean that higher rates are not going to affect the economy, because some institutions are still operating at, as if the effective federal funds rate were 33 basis points, because they've completely immunized themselves from all of the effects that still need to be felt. But those roll off in time. The interesting question, I think, is, okay, so you have this rate hike cycle, and you have some companies, if we think about it as a timeline, you have some companies over here that'll start to feel it. Will rates come down back to these levels by the time they start to feel it, thereby giving them the luxury of never having to have lived through any increase in interest expense? This is interesting here, is the drop in rates. The market seems to think that as soon as inflation, or at least there's a segment of the market that believes, and I'm not one of these, that as inflation comes down, as inflation is no longer a problem, the Fed will just then lower rates. I don't get that message from this Fed or from other central banks. The message that seems to be emerging from central banks is that it's time to end all of that extraordinary monetary policy on the zero line. It's time to get back to a more realistic level of neutral rates, not zero, but somewhere 2.5%, 3.5%, because monetary policy can be more effective at that level. And when you're at zero and inflation shows up, you got a long way to raise rates before you can start to affect demand. We're seeing that in the US, 500 basis points, and housing is on fire. Car sales keep climbing. The annual run rate just keeps going higher. It's not slowing a job market down at all. We keep adding jobs. So it just doesn't seem to have the same effect it would have 20, 30 years ago when you started raising rates at 3.5%. And that was your starting off point. And if like in Japan, if deflation shows up and you're at the zero line, where do you go? All you can do is flood the economy with currency and hope to create inflation at that point. But at 3.5%, you have an economy that can grow but is less prone to overheating. And then if you raise rates, you're raising it from 3.5%. To curb inflation, you don't suddenly have to add 500 basis points. And if you have deflation showing up and you're at 3.5, you can start cutting rates. You've got 350 basis points before you hit the zero line. So I don't think we're going back to a post-GFC world of 0% quantitative easing, rising balance sheets, and free money. And I just don't think that the equity market has really gotten that message yet. So let's move on. Real rates all retreated, almost a full rate cut on the 5-year, down to 189. So after last week of hitting new highs, they've all pulled back from that. You still have an inversion of 30 basis points from the 5 to the 10. For the Fed funds rate, it bottoms out in November and December at the same level, 94.635, implying a rate of 5.375. That is midway between 5.25 and 5.5. That is right smack dab in the middle, suggesting that there is one perfect rate hike in this year, and we will end this year there. One hike, no cuts. The market has it priced perfectly at this point. That's a drop of 5 basis points from last week, 5.425 down to 5.37. Going out to the end of the first quarter of next year, March, 10 basis points lower. The implied rate is 5.185 instead of 5.285, implying some cut somewhere along the way. This anomaly over here is just due to lack of volume on that particular month. TLT, actually, sorry, let's look at 2024, ending at 4% versus December 23 at 5.23, 123 basis points lower. So 5 rate cuts next year. Same as last week, it was sitting at 5 rate cuts. TLT had a fairly good week, up 2.23%, SPY up 2.45%, and consistent with that, implied volatility again has disappeared. I have made no changes to my TLT or my ZB positions. They did quite well. I was happy with that. My short beta position did not do well, but my duration position did well, and that is the point. That is what I'm hoping to see, is the negative correlation between the two showing up, so that when the market rises, yields drop and duration pays off. That's the hedge that I'm looking for. Something somewhere is going to break, but as long as I have that negative correlation in place, then I don't feel, or my portfolio value doesn't feel the hit of the negative beta, because the positive duration sort of offsets that. That's not saying that I'm happy with what I have. I really wish it was the other way around, but you got to take what you get, right? And the market right now is telling me to assume the position, I'll tell you. But TLT, I'm very happy with. I see no reason to exit this trade, even though it has a nice gain in it. I see no reason to exit, because money market rates are pricing in the 25, capital market rates are pricing in cuts. So if the central bank does raise 25 in 10 days, money market rates have already opened up a spot for it, and TLT is here. Long rates are where they are, and long rates are not ignorant to the fact of where money market rates are. So they can clearly see, the capital market participants can clearly see that money markets are suggesting there will be 25, and they're saying, yeah, okay, and we're still here. So even if they do raise 25, it is not going to be a shock. So I don't think that TLT will respond negatively. But if there's any indication from Powell, any dovishness in the press conference, that they're done for a while, or that they're on pause and assessing the data, and if he says the data coming in so far is promising and things are moving in the right direction, and we feel fairly good about that. If he says stuff like that, then yeah, I think capital markets will be yields will be under pressure. And prices will move up. So I see no reason at this point to make any changes to TLT or ZB. And if anything is put to me, I'm perfectly fine with that. My highest level put is 102. I'm thinking that I may, in early August, roll up my puts. Roll them all up $2. I may do that, but we'll see how things unfold. All right, lots of interesting, exciting things here. Mortgage rates as of the 13th. We don't have the benefit of Friday, only Thursday. 6.96, just shy of 7%, up 15 basis points. Given the market reaction to the CPI and the PPI, this to me seems rather odd. The 10-year over that period of time contract 29 basis points, but mortgage rates increased 15. The spread increased 44. But it didn't seem to affect much here. Agency up 3.79, Annaly up 4%, Arbor up 7.36%, and this is because last week there was money flowing into the small caps, and ABR is now in the S&P 600. IYR up 2.88%. This short position is not working out very well for me. Digital Realty up 3.93, still riding the AI wave on that. Lots of debt on this guy. I had sold puts on it before, and I haven't done much since, only because it's not something I'd want to own. I did it with the AI hype, thinking it'll get a run as well, and it's still running. The home builders are the story. ATH means all-time high. all-time high. Okay, they're higher now than they were in the housing boom leading up to the subprime mortgage meltdown when housing was on fire. They are higher now. DHI up almost 13% on the week at an all-time high. Lennar up almost 11% on the week, all-time high. Pulte almost 10%, all-time high. Toll Brothers 8.74, all-time high. KB Homes up 13.08%, not at an all-time high. And Hovnanian up 17.86% on the week. Incredible. The XHB up 7.12%, almost an all-time high. The ITB up 8.5%, all-time high. A while back, I had reduced half of my exposure to the housing stocks, and I'd stopped selling puts because they'd just gone so far in such a short period of time. And here they are, pushing all-time highs and going even higher. Tuesday, we have the NAHB Housing Market Index. We had last saw it at 55. I don't know where it can go from there. Wednesday, permits and housing starts. Thursday, existing home sales. OAS continues to contract. We're hitting lows here. Look at this on high yield, under 400 basis point, 3.97. Triple C, 9.29. You know, risking printing an 8 handle. Triple C, in default or near default or in bankruptcy, 9.29. Issuance year over year, up 0.5% for U.S. corporate bond issuance. This is investment grade, high yield, and convertible as last year over here. 73.9 billion investment grade this year, 101.7 billion in issuance at higher yields. High yield was 11.2. This year at higher yields, 15.2. So there is no shortage of appetite for credit, both investment grade and high yield. Issuance year over year at higher rates is higher. And issuance for the year so far, for the first 6 months over the first 6 months of last year, is on par. Let's have a look at CPI. We're looking at Table 1, all items 0.2. This is May 23 to June 23, 0.2. April to May was 0.1. This is 0.2. Food, 0.1. This is food at home. Food away from home, we can see here 0.4 versus 0.5. Energy, look at that. If we look at April to May, big drop there, 3.6%. In fact, nothing but negative numbers here in this column. Well, go from May to June. It's all mostly positive numbers. And I expect that energy will continue to be priced high and, if not, go even higher. There is a Greenie conference. I say Greenie, climate change. It's not a matter of addressing climate change with a broad-based discussion. It's a Greenie conference. It's a matter of addressing climate change with nothing but windmills and solar farms and electric vehicles moving to a carbon-free future. There was a statement issued about carbon capture that it should not even be considered, that it should have no time in the conference at all. It should not have a voice. It should not have a place. We need to move away from fossil fuels 100%. Well, carbon capture does take carbon out of the air. Now imagine if you took a barrel of oil out of the ground and it emits a ton of carbon, and you pull a ton of carbon out of the air. You're neutral. You're carbon neutral. But no, fingers in the ears, la, we're not listening. It must be green. So you have the Greenie. It's not a climate change conference when you silence certain voices. It is a Greenie conference. Well, one of the other statements that were made was that we need to move away from investments in fossil fuel and in fossil fuel exploration, that there actually should be no more new exploration in fossil fuels at all. Like, you got to think about, well, how narrow-minded and simple-minded can you be? You are actually encouraging energy inflation at this point in time, because forget about juniors. There'll be no new company forming. It'll be a consolidation among the majors, and then it will be supply management. And in 2 or 3 years, don't be surprised when oil typically runs 150 to 200 a barrel. And by the end of the decade, don't be surprised if it's running $300 a barrel. This is a harvest situation at this point. Oil will be with us for another 20 years at least, because electric cars only make up 6% of the road right now, 7% of the road. That means, and ICE is still selling 93% of the vehicles each year. And if the average life of these vehicles is 10 to 11 years, which if you look on Fred for average life of vehicle, you can see it's been creeping up over time, 12 and a half years. You're still going to need this for a long period of time. So the oil companies right now are unburdened from investing. They don't have any capex in that sense. Maintenance capex, and that's it, but no new exploration capex. If they hit a new field by drilling deeper, so be it, but that's it. It's a harvest situation. You're going to squeeze the price of energy higher. So it is, you can enjoy the negative numbers for a while, but I think that energy is going to be a big deal going forward. To just make a statement of saying we're not even going to listen to carbon capture, to me it means that you have a group of people who are ideologically driven at this point, to the extent that they will not listen to good technologies that will address the problem if it's not their technologies to address the problem, right? All items less food and energy, 0.2. That is a nice drop. 0.3, 0.4, 0.4 down to 0.2. Where'd it come from? Commodities less food and energy. This is for commodities. Negative 0.1. That is a big drop. 0.6, 0.6 down to negative 0.1. Big drop there. Used cars and trucks, negative 0.5. That's the only negative sign there, the negative 0.5. Everything else is either 0 or positive. It is the used cars and trucks that have dropped, negative 0.5. Let's go to services less energy services, 0.3. So we had 0.3, 0.4, 0.4, 0.3, kind of in line with everything that we've had. Shelter, 0.5, 0.4, 0.6, 0.4, kind of in line again. Rent of primary residence, 0.5, 0.6, 0.5, 0.5. There was some big discussion that the base effects are rolling off. Well, I don't see that. That's still 0.5. Airline fares were the big drop there, 8.1. Interesting, right? Used cars and trucks, negative 0.5. Airline fares, negative 8.1. I thought they were on fire, but they're dropping. Either way, I think this is good news for the Fed, the drop in commodities, less food and energy, 0.1, although it only came from used cars and trucks, the negative 0.5. Let's have a look at PPI. We'll start with the chart here, the 12-month percent change in selected PPI, and you can really see it coming down, right? The blue is a final demand for goods. The red is final demand for services. Here's the difference between the PPI, final demand, and CPI. It's measuring the same thing but from two different viewpoints. CPI is measuring what the consumer pays for product A. The consumer must pay for product A. It cannot be paid for them. So let's take a hospital visit. If a consumer pays for a hospital visit, it's in CPI. But if the insurance company pays for the hospital visit for the consumer, it's not in CPI. The consumer must pay for it. In PPI, it's in PPI regardless of who pays for it. It is the money that the producer receives for the hospital visit, regardless of who pays for it. But CPI only measures what the consumer pays, not what the insurance company paid. So that's the big difference. So you're really measuring price, the price level of the same things, but from two different points of view. One from what the consumer pays, one from what the producer receives. You'd think they'd be the same thing. But the consumer price index is what the consumer puts out of their pocket onto the counter. That includes sales tax. That is in there as well. And only what the consumer pays for. And producer price index, again, measures the same thing, but what the producers receive. So when the consumer pays $100 and another $6 in tax, that's $106. That's the price point for the consumer, but it's only $100 for the producer. So prices are measured from 100, any increase from 100, whereas for the consumer, prices are measured from 106. And any increase from 106. So an increase in sales tax can increase the CPI, but cannot increase the PPI. Now, this is what producers are receiving. I want you to think about this for a minute. We're going to get earnings from companies for April, May, and June. There's April, and let's just look at for the goods producing. There's April, slightly above zero. There is May. They're receiving 3% less, right there, -3 on a 12-month basis. And June, they're receiving even less. That's their revenues. That is what they are receiving. Their revenues are in deflation, which means they need more quantity. When your prices are in deflation, you need more quantity just to say that your revenues are flat year over year. So if prices are down 3%, you need roughly 3% more quantity just to end up with the same revenues, because revenues is price times quantity. So if price is down, quantity has to be up to overcome it. I think that was overlooked. We're going into an earnings season. We're saying, okay, well, great. One thing about deflation is that it's brutal on company revenues. It squeezes margins, and we're seeing it right here. There is April, there is May, there is June. So of all the companies in the goods producing sector that are reporting, these are the dollars that are received. That's what PPI is measuring. That gives us an insight into where revenues are going to be in terms of growth. Flat to negative growth in revenues. If we look at services, look at that, it's straight. It's basically a straight line right across. There is no improvement in that. Let's go down and look at Table A, monthly and 12-month percentage change in selected final demand. Now, so the PPI has two types of indexes. It has final demand and intermediate, where it has stage 1, 2, 3, 4. And this is the value channel. You know, stage 1 sells to stage 2 sells to stage 3. There is a belief that that's what PPI is measuring, is that it's measuring the input costs to companies and will they pass that along. The bigger index is the final demand, because that gives us an idea of the revenues that they're receiving rather than what's going through the pipeline. What's going through the pipeline, if the costs are reducing through the pipeline, and we see deflation from stage 1 to stage 2 to stage 3, but we see inflation in final demand, that is margin expansion. So we can get a very good idea of where we think margins are going. They don't have to pass through those cost savings. We find out if they pass through those cost savings when we look at final demand. So let's look at Table A. This is monthly and 12-month percentage changes in selected final demand price indexes, seasonally adjusted. We have final demand goods, we have final demand services. Total final demand, June, 0.1. Look at the month before, it was negative 0.4. April was 0.1. March was negative 0.4. February was 0. So 0.1, we've gone from negative 0.4 to 0.1. That's an increase month over month, right? Final demand less food and energy, 0.1. It was 0, now it's 0.1. If you look at the last 4 months, 0.1, 0.1, 0, 0.1, really not much of a change there. Final demand in goods total, 0. It was negative 1.6 the month before, 0.1 before that, negative 1.1. We're at 0. Negative 0.1 here for foods. It was negative 1.4, now it's 0.1. Energy was negative 6.8 in May over April. June was 0.7. and less food and energy was 0.1. Now it's negative 0.2. This is sort of the important number because it's taking out food and energy. And if you look back, January 0.6, 0.3, 0.2, 0.2, 0.1, negative 0.2. So it is the, and even going into 2022, notice you have no negatives. It is the first negative in the last 12 months. For final demand services, 0.2 was 0.2 last month, 0 the month before. Trade 0.2 down from 0.7. Transportation warehousing negative 0.9 from negative 0.5 the month before, and other was up, which creates a final demand for services flat month over month. This is monthly and 12-month percentage change selected intermediate demand price indexes. So this one over here was the final demand. This is the other side of CPI, right? This is what the producers are receiving for what they're selling to the marketplace. And this is intermediate, so stage to stage to stage. For June, total negative 0.6. Continuing on the negative trend that we've seen for most of the year. Look at February, negative 0.4, negative 1, negative 0.5, negative 1.5, negative 0.6. Food and feeds, negative 0.1. Energy goods, negative 0.9. It was negative 6.9, but negative 0.9. We've seen that in CPI, that it is actually higher month over month and for final demand. Less food and energy, negative 0.4. Total change from 12 months ago, negative 9.4. Again, we're talking about intermediate demand price indexes. Unprocessed goods for intermediate demand. This is processed, this is unprocessed. Negative 2.1. Foodstuffs and feeds, negative 4.6 to 0.9. Energy materials down again. There was 7% last month, another 5% on an annualized basis this year. Actually, I think, sorry, that's not annualized. This is just month over month. Sorry about that. Non-food materials, less energy, negative. And look over here, change from 12 months ago, negative 32%. Those are big numbers. So in the intermediate price indexes are showing outright deflation across all of them. The final demand, not so much. So we can expect, based on what we're seeing here, we can expect the goods producing companies to show probably flat revenues, if not shrinking revenues year over year. If we're looking at the same quarter last year, probably a decrease in revenues. But because the intermediate costs are in outright deflation, but you don't have the final demand indexes completely in deflation, we should expect to see maintaining their margins on flat to lower revenues. Okay, let's look at corn, and we'll look at wheat. There was the WASDE report. Both of them were, the report was negative for both of them. And then going into Friday, we had rallies in both. The big thing here is the Black Sea Grain Initiative up for renewal on Monday, and Russia has been silent on the whole thing. They are asking for certain things that are just not going to happen. Let's have a look at the report and how we would read the report. Let's start with corn. Area planted increased from 92 to 94.1. This was the estimate. This was last month, and this is this month's estimate. So it's the estimate for the same thing. What's the area that's planted? Last month the estimate was 92 million acres. Now it's 94.1. Area harvested 84.1, increased to 86.3. Yield per harvested acre has dropped, however, from 181.5 to 177. So we have to go to look at total supply here. 16,742 to 16,747, a small increase. And if we look at total usage down here, 14,485, no change in usage, slight increase in supply, so that our ending stocks increased by 5, but the projected price still remains the same, 480. This is 481. It seems to be bottoming. That's a terrible color on black, right? Seems to be bottoming around 480. I've sold puts so that my average cost is slightly, I think slightly below that. Not much below that, but slightly below that. We ended at 514 and a quarter. Midwest dryness is expected for the next 4 weeks, which is not helpful for the crop. Moving over to wheat, what is going on here? We can see area planted, the estimate has dropped. Area harvested, the estimate has increased, and yields per acre have really increased as well. So we go to total supply, 23.99 to 24.49, increase in total supply. For total use, 1837 to 1857, there was an increase in total use as well, but still our ending stocks went from 562 to 592. So the estimate of the average price per bushel, 770, dropped to 750. But you lose the Black Sea exports, then you have very tight supplies. So wheat could get a bounce off of that. But if you get a solution on Monday, if Russia says, yeah, okay, we'll extend it, then I think that the market gives back on wheat, but I don't know if it gives back on corn. I guess we would have to see any updated weather forecasts for that. European corn crop, and we're still talking about corn up here. European corn crop is at risk because of heat, and the Brazilian crop, the yields and harvests came in slightly under estimates, so that puts a bit of strain on the corn market, and that might have given some of the boost going into the end of the week. Whether it gives back or not, I don't know. If you get a solution to the Black Sea, wheat will give back. Corn seems more tied to the weather pattern, so we'll have to watch that. Okay, here is the Canadian, and you can see with this green line here, I am short CAD, long US, which means I'm long the pair. This is a 1 week chart. Here is the Bank of Canada. Increased 25 basis points. I wasn't expecting that. That is why I had this position on before the announcement, thinking that, you know, I'm going to be Mr. Smarty Pants here and be right. And all the forecasters will be wrong. Well, that didn't work out that way. Once this was announced, our yield curve went steeper into inversion. Also, what caused this continuation to go on was the Bank of Canada's forecast inflation returning to 2% target in 2025, but 6 months longer than their previous forecast. So that added to the Canadian strength. And down here, we're looking at the Canadian at a 10-month high versus the U.S. And then it just sort of gave back on Friday. I was looking around on Friday for some defining reason why it was giving back, other than my thought that, okay, yes, they did raise rates, but the market is forward looking, right? The currency, I was thinking, okay, so you've priced in the rate hike, but now there's nothing left. That really the belief should be that this was it. They're done, but the U.S. is going to raise, the European Central Bank is going to raise, so interest rate differentials will be increasing from this point, so that it should be topping out about here. And I thought, well, for the whole market to get on that argument seems rather odd. So I didn't find any one defining reason for this, other than a growing sentiment that the best is already priced into the currency, and that anything more would more likely break the economy, which would be sort of a big negative for the Canadian. Nomura has a target of 137, which means continuing on. National Bank, Canadian weakening in the second half. And I think I saw one saying that the Canadian will head to 128.50, meaning that it'll give all of this back and continue to strengthen, which would not be good for my position. Not only that, I am unhedged, and I think that roughly about 65% of my own managed portfolio is in US dollars, so that every time the Canadian strengthens, my Canadian equivalent value, which that's what it gives me because my base currency is Canadian. So even if I have no positions, I will see my portfolio value change during the course of the day for nothing more than currency changes. So any strengthening of the Canadian at this point, I am unhedged, and I am outright short the Canadian at this point. Anything that works against me is rather painful. But my thinking is this: look, I always keep US dollars anyways. What do I care from day to day what the Canadian equivalent of it is? I always need US dollars anyways because I primarily play the US market. So what do I care? And last week I had said that I am beginning the process of moving to the US. I am looking at moving from Canada. That is a done deal, only because the tax rates here are very punishing and are expected to become more punishing. Because how dare I be successful in this country when other people aren't? How dare I? The government's going to show me a thing or two. So yeah, I am leaving the country. However, somebody in the comment section a couple of weeks ago said, why not consider Dubai or Singapore? So I looked into it. I don't qualify for Singapore, believe it or not. The minimum investment to get an investment visa in Singapore is 200,000 Singapore. Oh no, you need a company with revenues of 200,000 Singapore dollars, or an investment of 12.5 million, or was it I think it was 25 million. Either way, it was super expensive to get into Singapore, but not to get into Dubai. So I'm actually looking at Dubai. So if anyone has any opinions about Dubai, let me know. Zero tax in Dubai. Zero tax. Let's look at copper and aluminum. These are two commodities I think that are probably going to be a big story over the next 5-6 years in terms of the move to electric vehicles. You need a lot more copper in an electric vehicle than internal combustion. And if you're going to get battery range, you need two things. You need technology in the battery, and you need lighter vehicles. That means you're not making vehicles with steel, you're making it with aluminum. Copper had a good week, and all of the miners up. Look at COPX up almost 7% on the week. FCX up 6.31. BHP and Rio in Aussie dollars, in their own dollars, are up consistently with that. This is year to date. Not too impressive, underperforming. COPX up 11.5%. Rio in Australian dollars up 3.1. BHP almost flat on the year, and FCX up 8.33. But I've been selling puts on these in the US market on the US dollar counterpart. So when I sell puts on BHP or Rio, I'm really making two bets here. I'm making a bet on the US dollar, and I'm making a bet on the company. So there's sort of two bets tied up in there. So I sell more puts on FCX than I do on BHP and Rio, and I think I sell more on Rio than BHP. But I sell a lot more on COPX than I do on FCX. So these year-to-date numbers are the price performance of these particular companies. And this is price performance, so it does not include the dividend that is paid out, and it does not include the selling of the puts that are paid out as well. So once you include those in, and it really depends on the volume of puts that you're selling, but I've done quite well on the miners. Even though they've really gone nowhere, I've done quite well on them. Much like Oxy. Even though Oxy has really gone nowhere, just the put selling alone I've done incredible on. Same with GM. It's gone nowhere really through the year, but just the put selling I've done very well on. Let's have a look at aluminum. Aluminum just not doing very well. Alcoa is the big play I have here, up 1.26% on the week, but down 23% on the year. 3 downgrades in 3 weeks. This week was JP Morgan downgrade to neutral, target price of 36. Previously they were overweight with a target price of 54. That is a big downgrade. The week before, Wolf Research put them to a sell with a price target of 25. The week before, Morgan Stanley put them to a sell, price target of 33. And this line here is 2023 onwards. You can see very clearly aluminum prices have given back, and only in the last 3 or 4 days has aluminum seen a little bit of a bounce here, but still in a downward trend. JP Morgan gave a couple of reasons. The big one here, you got lower aluminum prices. So yeah, that's going to do it, because that is just margin compression. As the aluminum price drops, your costs don't drop, your labor costs don't drop, your overhead doesn't drop, just your selling price drops. And capacity startup in China, 1.4. They have a capacity of 1.4 million tons per year. So they note that as well. So yeah, you have some near-term issues with aluminum. So Alcoa, I think, is going to be a hold for me for a while. I don't know if I would sell more puts. I'll wait till their earnings. The expected EPS from JP Morgan is 55 cents. The consensus is 40, so they're above the consensus at 40 at 55 cents. We'll see what their earnings are, and we'll see what their guidance is. From there, it'll dictate what I do with Alcoa. But as of now, I do have shares of Alcoa. I've done fairly well selling the puts. I think I got the 30. I think I got a 33 and a 30 put for July 21st that will expire. So they expire next week. I don't know if they're in danger of hitting the 33 or the 30, but I may close them early in the week. I may not, wait till they expire. They're both in the money. When I say in the money, they're both in profit for me. So I could just book profit, but we'll see how the week plays out. Hard to, on a Sunday, it's hard to look forward and say, here's what I want to do. I got to see how the market opens. I got to see the tone. I got to see what earnings are coming out at. I got to see what the sentiment is, because in a market with a lot of positive sentiment, even poor performing stocks will go up, right? In bull markets, 90% of stocks go up. So even the underperformers will still go up. So I just have to see how the tone plays out. Okay, we'll look at the index and then we'll look at earnings. Forward 4-quarter operating earnings, we've moved forward 1 quarter. Q3 23 to Q2 24, 227.70, which is down from what it was last week. Closing on the index 45.06, almost at 20 times forward operating earnings. On an as reported basis, 206.62 puts it at almost 22 times forward reported earnings. And the index right now is sitting 6% below all-time highs, not year-to-date, not 52-week high, not a 2-year, even a 5-year high. All-time high, record highs. There's never been a better environment as far as the index is concerned in 6.01%. It'll tell you there's never been a better environment for valuations and pricing. Wow. That is the run here, right? And this is a bit of a sideways consolidation, and then you had the AI breakout, and then up we keep going. I don't know what I'm going to do with my short position. I feel very comfortable with my short position, given the macro backdrop, given everything I know about it. I feel very comfortable with it. We have an index of leading economic indicators, not a single indicator that is 70% right or 80% right, but an index of indicators that are 70 to 80% right. When you put an index together, it's hard to be wrong. Over a year, it's in recession. Well, now it's in recession territory, but was it 15 months of negative reads on the leading index? Never has it been here, and the economy has escaped a recession. You have curve inversions in a number of different curves, regardless of how you measure them. The big one, the 3-month to the 10-year money market to capital market, never has the economy escaped a recession when that has been inverted, and never has it escaped a recession when it's been inverted this deep for this long. You have depth times duration. Never has it escaped a recession. So, with some of these fundamental indicators having a perfect track record, it's hard to get on board. Now, I have listened to the long side. I've listened to the bullish camp because I think I got blind spots. What am I missing? What am I missing here? It can't just be behavioralism and momentum. It's got to be something else. Almost to a person, the bullish camp's argument is along the lines of, yes, valuations are stretched, but that doesn't mean they can't go higher. That there is sort of a mass concession among the bulls that, yeah, valuations are stretched. You got us there, but that doesn't mean anything. It's just brushed aside. So the bears are saying the backdrop looks terrible. Earnings quality has been deteriorating. Rates are higher for longer, and something somewhere is going to break. And look how massively overvalued we are. And the bulls say, you're right, we are overvalued, but so what? That doesn't mean we can't go higher. And the recession may not happen this year. It may happen next year. And I'd say about half of the bullish camp that I've listened to, almost half, acknowledge that there is a recession, but it's being pushed off. It's not going to happen this year. It's sometime mid next year. So we get two concessions out of the bulls. Yeah, we're overvalued, and there is a group of them saying, yeah, we're overvalued and there is a recession, but it's in the distance. We can go higher from here. All the way to some bulls that say we're going to get a blow-off top. A blow-off top, which means straight up. At some point, it's just going to explode and go straight up. And then the bears will come in because we'll be so far above the 200-day moving average, they'll be profit-taking at that point, but not before we get a blow-off top. I don't know. As you know, I am short beta, and that has not been working out as a top-level trade. When you're short, you have to be tactical. And I have been tactical in this period of time over here. This was great because you add short beta, you reduce short beta. You add, you reduce, but then the AI thing caught me off guard. The run since NVIDIA's earnings caught me off guard. I thought that we would be capped at 42, and nope, here we are at 45. However, short beta has sort of resulted in me being more aggressive with my duration. The number of puts that I sell on TLT is higher than they would be if I wasn't short beta. And these two things, if they're negatively correlated, are basically the same trade, right? So, I'm beginning to think, do I really need short beta if I have long duration? I haven't resolved that in my head. I'm also getting my long beta from different places as well. I had it from the home builders, but I reduced my position by half. I have it with the mortgage REITs. I have it with the GM and Ford. I've had exposures there, but as they go higher, I reduce my exposure because I just don't see a lot of upside to them right now. But Ford at 12 or lower, I think, is a buy. GM anywhere under 35, I think, is a buy. And because it bounces between like 32, 33 up to 40 to 42. And I think we're over $40 on GM now. Oxy is another great one that I add a lot of beta on. Whenever I need to add some beta, I go to Oxy and I sell puts. It's good enough for Warren Buffett. It's good enough for me, and it's held its ground at the high 57s for quite some time. It goes down into sub 58s. It doesn't stay there long before it comes right back because I think that the oil price is going to be managed from here on in. If you take Oxy and you go look at their cash flow from operations and calculate their cash flow from operations per share, their CFO per share, and once you have that, calculate a cash flow yield based on the price. You'll understand why Warren Buffett loves this, because that cash flow has got to be returned to shareholders some way, either through dividends or share buybacks. It's not just going to sit in the bank account. It's got to be returned with a diminished exploratory capex, and with just maintenance capex, that cash flow is going to build up over time. And it has to be returned to shareholders. So I'm comfortable with that. But we got to be careful with Oxy. They have earnings coming up, and Exxon's already warned on natural gas. that their earnings will be lower because of natural gas, and Oxy has exposure to natural gas pricing. So we may see a retreat on Oxy. And what I will do if it does pull back is I'm going to sell $560 puts, 60 days to expiration, 2 months out. If they do have a pullback on earnings, I'm going to sell 500 of them. So, I've been looking at my short beta and thinking about it, and then I sort of look at the other things that I'm doing, and I think, would I be as aggressive in these positions if I didn't have the short beta? And the answer would be no, I wouldn't be that aggressive. So it is the short beta that is allowing me to be more aggressive. So I think that it is serving some purpose being there, even though I'm losing on it. It's serving some purpose by putting me in positions where I feel I need to add more aggressiveness there. And those have been working out quite well. The miners and Freeport and COPX have been working out. Not a lot of upside to them, but they're being well supported in the market. So selling puts is just a way to print income each month. Oxy has just been fantastic. GM, Ford are just fantastic every time they pull back. So I hope we continue to have that. Duration has been working out for me. I do want TLT put to me, but it doesn't seem like I'm going to get that. I'm going to have to get more aggressive. I'll probably roll them up in early August if TLT is above 102. I'll probably roll up all my puts, $2 I'll close the August and go into September and roll them up $2. I just can't seem to not lose on TLT, which is nice, but this little guy, this son of a bitch, is really beginning to bother me. I feel very convicted in my short position. I feel that I'm gonna be right. It's the pathway to being right that causes a lot of pain, and right now I'm just not happy with the position. So I don't know how much longer I'm going to hold it there, but I am tactical. I do know how to work my way out of trouble. I'll see how earnings flow out this week. I'll see what the tone of the conversation is this week. I'll see if the market that we had on Friday, the indifference to the earnings that happened later in the day, I'll see if that indifference falls over into the beginning of the week and the market says, you know what, we've had a good run. This is really good. We should book some of these profits now. Let's find out. Let's have a look at earnings and we'll wrap it up for the week. So we have 62 companies that are reporting this week. Not much on Monday. You have one before the bell opens, but it really starts Tuesday morning. A whole bunch of financials still. We got a lot of financials this week. You could just look down. You can see all the financials. I'll order this differently in a little bit, and you can see just how many financials we have. And starting Wednesday, we start to get move away from the diversifieds to the regionals. Wednesday, Thursday, Friday, we get some regionals. I have some puts on KRE, and we'll see how the regionals are doing. So who do we have? We have Bank of America, Bank of New York, Charles Schwab, Morgan Stanley, PNC Financial, Prologis. I have that. That is a REIT, an industrial REIT for warehousing and logistics. Baker Hughes. I'm looking to sell puts on Baker Hughes and Halliburton. So I'll see what their earnings are like, and if they come in light or if they take a bit of a hit, then great. That gives me a good opportunity to sell puts. Failing that, well, we'll see what happens. You have more financials in here. There's Goldman. What do we got Wednesday? There's a big one on Wednesday here. You got Netflix and Tesla after the close. Two big ones there. IBM as well. Tesla will be interesting. That will be interesting. I think after the market closed on Friday, they reported that the first Tesla truck has rolled off the production line. I didn't anticipate. I thought, well, it's not going to happen this year. You get so used to Tesla saying this will happen and that'll happen, and it never does. And, years later they keep saying this will happen, that you just sort of get used to the fact that, wow, yeah, I'll believe it when I see it. Well, I guess there it is. And honestly, it's ugly. I just think it's ugly. I don't know. Maybe some other people like it. DR Horton on Thursday. I have that. Freeport, I have that as well. And they're on Thursday. So I got 2 risk events happening on Thursday. And of course, you can go through them. Schlumberger is another one I'd be interested in selling puts on. We'll see how they report. If you want to get a better view, we can organize it based on sectors. You can see what sectors are reporting this week. So you have financials here, you have diversified banks in this category here, and down here there are your regional banks. You can see which regionals are reporting. Oil, gas, exploration. I don't know that we have too many REITs reporting this week. Home building, only one, DR Horton. And that's it. 62. It's a light week. Going into the next 2 weeks, you have well over 100 in each of the next 2 weeks. So we are building into it. This week has got 62. The next 2 weeks are big. Next week, of course, we have the Fed in between all of that. But I don't know that the decision is going to be the surprise. It'll be the press conference, and it'll be the level of dovishness or hawkishness from Powell that will be the thing, not the rate hike. I don't think the rate hike will be the thing. I think it'll be any dovishness in that press conference. I think there is, and if earnings are coming in good, earnings have been strong, and he's any kind of dovish at all, I think, yeah, you probably have higher in front of you. There we are.